All right, welcome to this explainer. Let's get real right out of the gate here. I've spent decades navigating the completely unpredictable, often chaotic waters of the stock market. And if you ask me what the single biggest difference is between the professional traders who actually survive long-term and the amateurs who just get entirely wiped out, it comes down to a fundamental respect for one single word: risk. Today, we're diving deep into the mindset of a true professional trader. We're going to break down exactly why you absolutely must approach every single trade risk first and how mastering this one concept will, without a doubt, completely transform your portfolio. Listen to this. Every single morning, before the opening bell even rings, a master trader from our source material looks in the mirror and says this exact phrase out loud to himself: "Mark, you have the capacity to do serious damage to yourself today." Now, I know it sounds a little intense, right? But honestly, it's an incredibly powerful daily ritual. It forces you to acknowledge a brutal, totally unvarnished truth about the market. Stocks don't manage themselves. You do. You are the manager of your capital, and frankly, your own laziness, a lack of discipline, or just a simple failure to prepare are exactly what will lead to your financial demise. You have to look in that mirror and face the fact that in trading, you are very often your own worst enemy. So here's the stark divide between the folks who make a career out of this and those who are just, well, gambling. Amateurs operate with this incredibly dangerous return-first mindset. When they find a stock they like, greed just takes the wheel. Literally, all they think about is how much money they're gonna make. They can already taste the returns, they get super impatient, and they just jump in blind. But look at the other side of the coin. Professionals, we use a relentless risk-first approach. We actually don't concentrate on the upside. We focus purely on protecting our capital and preparing for the unthinkable. A pro knows exactly what they stand to lose if they're wrong, because in this business, if you lose all your chips, the game is over. Okay, so the million-dollar question is, how do we actually protect our chips in practice? Enter the stop loss. Now, you've likely heard the term before, but professionals treat it like a religion. A stop loss is the exact predetermined price at which you are going to retreat from a trade, no questions asked. You absolutely must define this specific price level before you ever put a single dollar on the line. I want you to think of it like an insurance policy. You're basically consciously agreeing to pay a relatively small fee, taking a small, controlled loss, to completely protect yourself from a catastrophic, account-destroying major loss. And yet, surprisingly, most retail investors completely refuse to use them consistently. Or, they get stopped out once, the stock bounces back, they get totally frustrated, and then they swear off stop losses forever. Let me put it this way, and our source material really hits the nail on the head here. Trading without a stop loss is exactly like driving a car without brakes. I mean, sure, maybe you can make it around the block a few times safely. A roaring bull market might even let you get away with reckless driving for a pretty good chunk of time. But how far do you genuinely think you can go before you crash? A major accident isn't just a possibility in this scenario, it is absolutely guaranteed. It's really just a matter of time. And this whole lack of brakes thing leads directly into one of the most common and frankly most dangerous psychological traps in the entire market: becoming an involuntary investor. You see, as human beings, we absolutely hate to admit when we've made a mistake. So when a short-term trade starts racking up a loss, instead of just cutting it, amateurs start to rationalize. Suddenly, without ever actually planning to, they become a quote-unquote long-term investor. They stubbornly hold on, desperately hoping the stock eventually crawls its way back to break even. By just refusing to accept a small loss up front, they trap themselves into harvesting this bitter crop of tiny little profits and massive, devastating losses. Now, the brutal math behind why these massive losses are so incredibly lethal is what we call the geometric reality of the market. See, when you let a loss run, you aren't just losing money, you are actually fighting a mathematical battle that you simply cannot win. Losses work against your portfolio geometrically, not linearly. The deeper you let yourself fall into that hole, the exponentially harder it becomes to climb back out, just to get back to zero. Let's actually look at the math here, because it is a literal visual gut punch for anyone out there trading without a safety net. If you take a disciplined 5% loss, well, you only need a 5.26% gain on your next trade to recover. Easy, right? A 10% loss requires an 11% gain. Totally doable. But look at what happens when discipline completely breaks down. If you let a stock drop 50%, you don't just need a 50% gain to get even, you need a 100% gain. You literally have to double your money just to get back to where you started. And if you ride a total disaster all the way down to a 90% loss, you need a staggering 900% gain. Think about that realistically for a second. How many stocks have you ever bought that actually went up 900%?
This exact geometric reality is why 10% is the absolute non-negotiable maximum allowable loss on any single trade, period. Beyond that mark, the math simply works way too heavily against you. In fact, a true professional trader's average loss is usually much, much less than 10%. If your actual goal is to achieve big performance in the market, allowing large losses into your portfolio is simply unacceptable. It's completely counterproductive.
Now, of course, controlling risk isn't just about placing stop losses. It's also highly dependent on your actual stock selection. You have to avoid what our source refers to as the black orchid trap. The author shares this really memorable story of visiting his uncle's farm as a kid and stubbornly insisting on riding this small black horse named Black Orchid. Well, this horse had a terrible reputation for kicking and bucking. The very second he got on, she sprinted toward a tree and just knocked him right off. Months later, he stubbornly tried it again. This time, she started bucking mid-stride, launched him straight into the dirt, and literally ran right over his back, leaving hoof prints.
The crazy thing is, far too many traders pick their stocks exactly like that horse. They deliberately target these highly volatile bucking broncos with massive dramatic price swings. And sure, maybe that wild stock might eventually go from $20 to $40, but can you actually stay on the horse long enough to see it happen? Usually no. The wild fluctuations just hit your stop loss, buck you off, and leave you in financial pain reaching for the Pepto-Bismol. A true professional, risk-first approach completely avoids the bucking bronco. Instead, we're intentionally looking for an obedient horse, a stable stock that can just get you safely to the other side of the corral without throwing you face down in the dirt.
So what does finding that obedient horse actually look like on a real chart? Take a look at this setup from Medivation back in 2012. Notice exactly where the trader is stepping in here. They're buying right at this specific level, getting in as close to their designated danger point as possible. This is an absolutely critical skill known as trading near the danger point for low-risk entry. By buying right here, you're giving the stock enough room for normal, healthy, everyday fluctuation, but you're keeping your mathematically defined risk incredibly tight. If the trade sours and breaks that level, your stop is triggered quickly and your financial damage is completely minimal. So, if the math is so clearly laid out and the strategy is logically sound, why do so many traders consistently fail to execute it? Well, it usually comes down to one highly destructive force: your ego. To succeed in this game, you have to accept a reality that is very difficult for most humans to swallow. You can be wrong, but the market is never wrong. Your ego is entirely responsible for stubbornly digging in and holding on to losing positions. It's the ego that says, hey, I know this is a good company, they aren't going bankrupt, I'm not selling. Please don't let your ego assertively drive you into financial destruction. Let's actually do a quick mental exercise here to expose just how tricky our egos really are when cold hard cash is on the line. I want you to visualize two distinct scenarios. In scenario A, you buy a stock, it starts selling off, you strictly follow your rules, you cut your loss, and you take a $2,500 hit. But the very next day, the stock absolutely skyrockets and you realize you would have made 25 grand if you had just stayed in. Painful, right? Okay, now visualize scenario B. You take that exact same $2,500 loss, but the next day, the stock completely plummets. Had you stayed in, you would have lost $25,000.
Now ask yourself the core question here. In both of those scenarios, the actual realized loss to your trading account is exactly the same, $2,500. But how do you feel? You probably feel totally sick to your stomach and angry in scenario A, and massively relieved, maybe even a little proud, in scenario B. But here's the thing, your bank account doesn't know the difference. This perfectly proves that your emotional pain is tied almost entirely to the ego of being wrong or just missing out, rather than the actual capital you lost. You have to learn to associate pleasure with taking small losses, simply because it means you executed your plan perfectly. And to master this level of emotional discipline, you need to deeply understand the illusion of control in the market. Human nature desperately wants to control everything, especially when financial risk is involved. But the reality is incredibly stark. Before deploying your capital and officially making a trade, you only have control over 3 very specific parameters: what you buy, how much you buy, and when you buy. That is literally it. You dictate those 3 things and nothing else. Okay, so let's dive into the sobering reality of what happens the very moment after that buy order gets filled. Once you are actively in the trade, you control only one single thing: when you sell. You cannot influence the stock. The stock is exactly like the weather. It's going to do whatever it is going to do, completely indifferent to your hopes, your dreams, or your late-night research. Your sell discipline is literally the only shield you have left to protect your portfolio. Knowing that you only have one decision left should tell you exactly how critical that final decision really is. And because we only have that one single control lever remaining, you must have a flawless, totally unshakable system for pulling it. Here is the strict protocol you have to implement to build a sound trading plan based on actual discipline, not hope. Step 1. Determine your stop-loss price in advance, before the trade is placed and way before emotions start clouding your judgment. Step 2. Write it down. Stick it on a Post-it note right on your monitor, or honestly, better yet, program an automated stop order with your broker. Do not rely on a mental stop. They are way too easy to just conveniently forget. And step 3. Cut your loss immediately without vacillation. When that price hits, you act. Zero hesitation.
Look, if you take away anything at all from this explainer, let it be this core philosophy of a professional trader. Long-term success in the stock market has absolutely nothing to do with hope or luck. It comes down to unwavering rules and a really well-thought-out plan. As a speculator, taking losses is not a choice. We all make mistakes, but exactly how much you lose is entirely in your hands. Not losing big is the single most important factor for winning big in the stock market. Because remember, every massive, career-ending loss always starts out as a small, manageable one. Mastery of the basics and stubbornly protecting your principal is exactly how you stay out of the poorhouse.
Which finally brings us to our last, pretty provocative thought here. The market is a demanding taskmaster. It will mug your pocketbook and completely beat up your psyche if you aren't prepared and deeply disciplined. So, you have to take a really hard look in the mirror today and ask yourself this critical question. Are you genuinely engaged in a disciplined strategy to make money? Or, by ignoring risk, refusing to use stop losses, and just letting your ego run the whole show, are you really just engaged in an exercise in self-destruction? It's a tough question, for sure, but answering it honestly right now might just be the exact thing that saves your portfolio.